thank you to each and every one of you for joining us today. Hope everybody's having a great day. We're going to talk a little bit about our underwriting here for Trophy Point. But first, it wouldn't be a webinar, right, without talking a little bit about our company. I am not Samir, right? My name is Dave Marold, and I'll talk a little bit about myself here shortly. But Samir is obviously my West Point classmate. We both graduated in 2008, and absolutely thrilled to be a part of this team together, along with Nick, our other 2008 classmate. So for those of you who might be joining for the first time, maybe you are thinking about making an investment, maybe you'll make an investment in the future, or for those of you who have entrusted us with your dollars already, just thank you for joining us. Our private lending fund has lent out $140 million in origination. Wow, that's amazing that we have already hit that milestone. But the more important thing, I think Samir always emphasizes this, and I will do the same today, and this is how, our underwriting is a crucial aspect of this, is we've been paid back $80 million. What that means is the money that's going out the door is being properly underwritten. That means we're getting it back in terms of a refinance or a sale from our borrowers. And the most important thing for you as an investor means that's how you get paid back. We've got over 700 loans. I think we're on track to hit, 1,000 sometimes next year. I think the best part that I like about this is that we are diversified, not only in terms of borrowers, but locations. We'll talk about our location requirements when I get to that on the underwriting side. And we also have 60% plus, I think we're at 62 right now, percent repeat borrowers. And again, I think that's a strength of our institution, our company, that we are continually lending to people that we've seen have a positive track record. And again, that's a huge performance indicator for us in the underwriting side as well. For you as an investor, probably most important is the steady interest payments that you get quarter after quarter. We have yet to miss a quarter, and we won't do that in the future. So we've got 15 straight quarters of interest payments, allowing you to either receive that easy mailbox money. And again, we hear that term thrown around all the time, mailbox money. And yet, any of you that's rolled up your sleeves and done an investment property just like myself, Samir, and Nick have, it's not easy, right? You're dealing with renovations, you're dealing with tenants, you're dealing with evictions, all these things. That's work. That's real, actual work. So yes, there's real money you made, but there's work behind it. And here we're trying to take that same real estate product, package up across a bunch of different loans, across different locations and borrowers, and then you're getting actual mailbox money. You're not talking to tenants, you're not talking to contractors, you just get the quarterly dividend. For those of you who might be in the reinvestment program, also a great opportunity to be able to take that cash that you're getting from us, reinvest it every time, roll it over so that you can get that compounding effect interest there. As Samir likes to, reiterate, we're always here to help, but not only just from the standpoint of lending money, but to be able to be a sounding board for borrowers, investors. I can't tell you how often we are on the phone with somebody. There's no sale at the end of it, and that's okay because we're not paid to be salespeople. We're here to build a network and to build a trusted organization and institution. So I think that's a real important aspect of this. And I know that some of you that have seen this webinar before, Michael Martin here, that's the social proof of the fact that there are times where we're not going to do the deal. We're not going to book it. We're going to make $0, but it's because we're going to be honest. We're going to be honest with you as the investor. We're going to be honest with you if you're a borrower. And if we don't think a deal makes sense, we're going to tell you why. And we have saved, at this point, dozens, maybe, over 100 people from doing deals that we viewed were not sound investments, and ultimately the investor didn't go forward with it. And I think that is proof that we don't want to make one deal when we want to do multiple deals. And as I always tell a borrower, if the first deal you do with us doesn't go well, you're never going to call us again. Doesn't matter if it's my fault or not, you're not going to want to do the next deal. So our goal is for you to be successful as a borrower. That not only allows you to do more deals with us, it also allows you to be able to have, peace of mind that we're underwriting these in a diligent fashion. All right. So I'll try to boil this down in the simplest fashion. The way that you think of a traditional bank where they take money in from depositors and they lend it out to borrowers. That's essentially what we're doing here with a little bit of a twist. So we, as a private lender, take in money from you, the investor. We also are taking in funds from the three partners. There's a large percentage of this that's a partner equity stake. And then we lend this out. We lend this out to borrowers who are professional real estate people. A lot of them happen to be military affiliated. What do I mean by military affiliated? They could be on active duty right now and they're doing this for a side hustle. They could also be somebody who has transitioned from the military and is now a civilian. And ultimately, a lot of the civilian borrowers we have that may not be military affiliated are actually referred to us by military individuals. So that's kind of another, I'd say, unique underwriting characteristic that doesn't show up in a loan file. But when we get a referral from somebody that we served with or we know through the West Point network and they vouch for a civilian who didn't serve, we know that we can likely count on that borrower. Again, we'll talk about the other criteria we look at, but it's just another way that no other institution, no other bank is going to have that, knowledge file to be able to put together why it makes sense to do a deal for that person. And again, as we lend that money out, it comes back to us in the form of repayment, and then we pay that out to you all in quarterly dividends, or we roll that over into your account and allow you to compound that growth. Our update for July. We now are standing at 180 total investors, and we paid out $1.1 million in interest last quarter. We are just below 65 million in assets under management. That's a really big growth for us over the last 12 to 24 months, which is excellent. I think the key thing to highlight as overall macro view of the market right now is the loans paid back. We've had some robust payback numbers both in May and July, some of the biggest paybacks that we've seen since then. I think that's a signal that the market is starting to catch up. There was, a big shortage of liquidity in 2023 as the Fed was continuing to raise rates. It was pulling money out of the system. It was making it very hard for companies, borrowers, institutions to be able to get refinances or to be able to sell, because a lot of the sales are predicated on a buyer that can get some type of loan. And so now that we're seeing the market being a little bit optimistic, the fact that I think we're going to see some rate cuts here shortly, people are starting to get back into this game. They're starting to be able to get access to cash. And as a result, we're seeing the paybacks increase. So that's a positive thing, not only for our business, but the overall economy. We always do like to mention, if you look at the other options for you to invest your money, we feel like, both from a risk adjusted standpoint, we have a very, very high yield relative to your other options out there. So we always want to remind you that when you're thinking about your different options, which you always want to be diversified, you always want to have, more than one place for your eggs to be in that basket. We believe that we are a great piece of that diversified portfolio. And we also think that we deliver probably the best, or at least equal, risk-adjusted return that you're going to find out there. Again, our fixed income offering, we are standardized across these three tranches, 8, 10, and 12%. You'll see the minimum investments there at the bottom. For anybody that's new to this call or who does not have money invested with us currently, highly, highly recommend that you book time to talk with us. Anybody that has been through those calls, most of you that are on here that are investors that listen to that, I think you would all let your other peers on here know that it's a really great opportunity to talk with Samir one-on-one, get to know a little bit more about the business, and answer your individual specific questions. I think that's going to get you more comfortable with the asset class and, more importantly, our company and how we think about real estate lending. Again, for those of you who are not investors with us, we have these special rates for your Roth IRA or regular IRA or 401k accounts. All of these are eligible. They do have to go through a specific third-party custodian. You look at there at the bottom left corner. Advantra IRA, Forge Trust are examples of that. There are other ones out there. Again, please book a time with us. We'd be happy to talk through how that works. It can be a little bit of a frustrating and a confusing process, and we understand that. Between Samir and Danielle is also on the line here as well. If you have any questions on that, they can answer that very quickly. I think we're really getting better at being able to get that in there. And we have found that since we have offered this fixed income through retirement accounts, it's very popular. You can imagine that a lot of people don't like the tax treatment of this as it stays outside of a retirement account, but the benefit of you being able to get this fixed income, either, tax deferred up front, or, pay no tax on the back end when you cash out in the form of a Roth IRA, it's a very attractive option for any of you as investors. All right. So now we're going to take a little bit closer look at our underwriting process. Uh, I don't love this slide. I didn't create it, I'll be honest. But the only thing I want you to take away about me is I've been in the real estate game since 2008. For those of you who graduate at or near our class year, you know that it was a very unfortunate time for the US economy. But Samir, Nick, and myself were all very fortunate in that it allowed us to get in the real estate game early and to see how the entire industry plays out. I do not, and you won't see it on here, have any banking experience. I have done everything from single family to, huge apartment complexes. I have built homes ground up. I have built apartment complexes ground up. I have developed raw land. I have flipped and changed the zoning for land. I've done most of the different things that our borrowers are looking for. So the two takeaways from my background: one, I don't have a banking background. Neither does Samir. Neither does Nick. We view this as an actual advantage. Most of our competitors and our peers, when they're starting one of these funds, when they're evaluating or underwriting loans, they're looking at this solely from a banking background. The problem with that is you're creating a product that is not meant to be able to meet the needs of the borrower. And so for us, as people who started in the real estate game, we view this as a borrower-centric place. Our client, our customer, is the person that is going to borrow money from us and invest it in real estate and become successful. If we don't have a product that is competitive in that marketplace to allow them to be the best form or version of themselves as a real estate investor, we're not providing the value we need. So I think that's what you should take away from my background. All right. What is underwriting and why is it important? Oh, sorry, skip through there. So when we're thinking about underwriting, this is where we're getting to know what I call the 3 Ps. That is the person that's borrowing the money, the property, that's the collateral that we're using to lend against, and then the plan. In almost every single case that we get one of these deals, we want to ensure that there's a solid project plan to be able to get this from the point of closing to the point of either sale or refinance. That's key. Sale and refinance is really important because that's the only way that we get paid back, which is the way that you as an investor get paid back. So when I'm thinking about those 3 Ps, I start with the person. And when we're thinking about the person, we're looking at income, we're looking at their credit score. We're looking at their work history. We're looking at their experience in the real estate market. Is there the first time they've ever done a deal, or have they done 20? Have they ever managed a rehab? It's one thing to have experience buying, one or two personal residences as you PCS from military station to military station. And then you transition to buying a dump. And I'm saying this is like, I remember one of my first duplexes that I bought. I could stand on the 3rd floor and see all the way down through the basement. So 3 stories all the way down in there. It was over 100 years old, had a lot of problems. And so there's a distinct difference between owning a personal residence and rehabbing from start to finish, an old busted rental property that you're trying to convert into something that's going to say cash. So a transition, that's the person. There's the property. If for some reason we screw up and we lend to the wrong person, for whatever reason, our underwriting criteria messes up that, we want to make sure that we have a property and collateral against. We'll talk about loan to value ratios and et cetera in a little bit. But the bottom line is, if for some reason somebody stops paying us a monthly payment, we can go in, we can foreclose on that property and take the asset back. And we want to be able to take that asset back and be able to turn around and sell it and to get all of our money back, hopefully, and then some. That's the goal. But the bottom line is we need to be able to be made whole just through the property. So understanding where the property is located, what's the current condition? Is it have tenants in there? Does it not have tenants in there? Is it located in a big town or a small town? We'll talk about how we view metro areas here in a little bit. So thinking about that property is kind of my thought process of, if the worst case scenario happens, and maybe it's not even a bad borrower, maybe the borrower for whatever reason gets hit by a bus tomorrow, they don't even do anything wrong, we still are on the hook to get paid because we have to pay you as the investor. So we've got to be able to take that property and turn it into cash. That's how I'm viewing every single property, is as if we're going to have to take it over and find a way to get out of it. The last thing is the project plan. We're looking to see, number one, is there a plan in place? If I don't see a plan, that's probably a red flag right off the bat. But two, is the plan executable, and is it going to get us to an after repair value, which you'll hear in the industry called ARV? Is it going to get us to a place where that value makes sense relative to the amount of money we lent out? Is it also going to allow the borrower to lease up the building? Is it allow the borrower going to get a refinance? Is it going to allow the borrower to sell the building? All of these things are critical for us to assess whether or not this is a project we want to get involved with. All right, loan eligibility criteria. So when we're looking at this, this is not an all-encompassing checklist, but these are certainly some things that we're going to consider. Myself and the underwriting team, going to consider. We have recently worked with Mortgage Automator, which are software producer, and we actually have kind of boiled all of these down into a mathematical formula. So what I have done is I've looked at all these different things, the property, the person, the project, and all of the stability that goes with that. And we come up with a scale of 0 to 100, essentially. And so as we get this information as far as what the property is worth, how much the person brings in on income, what their credit score is, what their experience is, it actually gives us an overall loan card score. That loan card score is kind of our proprietary way of looking at the underwriting for the loan and reducing the risk of the portfolio. So some really, high level, easy ways to think about this. The first one is, what type of lien are we going to get? You will see lenders out there that will take second lien positions or sometimes unsecured positions. We do not do that. So we always are going to have a first lien position on the asset. Specifically, what we're looking for is not only a first lien, but the first lien being at 65% or less of the after repair value. So there's two important things. One, what's the type of lien we're going to take? It's a first lien. Second, what is that lien on? It is on the property at a loan to value of no more than 65%. So the example being, if the after repair value of the property is $100,000, we would not want to lend out more than $65,000. All right, two, the property or collateral specifics. What we're trying to figure out here is, what is the shape of the house? What is the shape of the condo, the duplex, the apartment building? And so the way we look at that is we get real-time pictures of the property. And so those are uploaded into our system. It gives us an exact snapshot today of, is this something that is able to be rented or resold right now, or is it a giant dump and we need to have a lot of work to it? The second piece, to the extent if it needs a lot of work, is, do we have a borrower that's done this before? What is their track record? So for some of our clients, we talked earlier, and I think one of the greatest risk reductions for us is over 60% of our clients have already done a project with us. That's a huge advantage and differentiator between us and other lenders. There are a lot of lenders that number is in the 20s, 30s, 40%. So the fact that, 6 out of 10 or 3 out of 5 of the borrowers, we've already had them do a project with us and it was successful. That's a really big help to our portfolio because we've seen them in action. We've seen them take these properties, bring them back to life, make that neighborhood a better place to live, make it better for the buyer or the renter, and then they've paid us back. And so that gives us a lot of confidence in their ability to repeat that again. Now, for those people that have never done a loan with us, how do we get comfortable with that? Well, we are looking to see what are their previous projects. So they have to be able to give us, hey, here's maybe a schedule of all the real estate I currently own right now. And some people, it could be as high as 50, 100 properties. So we check that out. We make sure that the title clears, that they do own those, and that gives us a pretty good understanding. If somebody has 50 rental properties, they probably have a lot of experience. For people that are a little bit smaller, maybe they're flipping and selling properties, we want to look at the actual closed listing. So we'll get the address for that, check that against their LLC to make sure their LLC was the person that sold that, and see, were they able to actually buy that for less, sell it for more. That again gives us confidence of their ability to execute the plan. And that really rolls into number 3. We're looking at the actual collateral specifics. Then we're going to the experience of the borrower based on how bad that property is to figure that out. All right, number 4. I think that the financial capability piece is huge. We are consistently looking for anywhere from 10 to 20% down payment. We're looking for cash on hand to be able to make those monthly interest payments. We've really recently upped our credit score, so we won't do anything below 675. There are a lot of people in this space that are lending at 650, 600, and we have increased ours up to 675, and quite frankly, the majority of our clients are over 700. And so we verify those. How do we verify those assets? We do that through a PFS, so that financial statement from the borrower. We do that through current bank statements. So we look at least 2 months bank statements for each account that's going to show liquidity. And then we also look at that schedule of real estate owned for people that have that and verify what is the actual mortgage against those, determine the equity in that portfolio. Number 5, I would say not just whether it's a judicial or non-foreclosure, but what location are we going to lend in? We will not lend in non-judicial foreclosure states. So example, that would be California, but we also don't want to lend in certain cities. We don't want to lend in cities that are too small. So, if you have a 10 or 5,000 person town, that's probably not a good fit for us unless it's within a metropolitan statistical area that's over 100,000. So it might be, 5 or 10 miles away from a downtown core, then we'll take a look. But if it's, off on its own, that's probably a deal breaker for us. We're also probably not going to lend in like the top 10 real estate markets. So things like LA, New York City probably aren't going to be a good fit for us. Why? We're not in the equity game, we're in the debt game. So when you look at the larger MSAs, they can have really nice appreciation, Washington, D.C., LA, New York. But the other problem is they can have a large, break in price as well at certain times. We just saw this with the Austin, Texas market as it was growing. It had a huge increase in price, and then it had a huge come down as well, right? And so we want to avoid those big, essentially, betas, that huge difference. And we want to be in places that are a little bit more stable. What that looks like is southeastern states, Midwestern states, states that are near military bases. They tend to have a lot less of this break in or reduction in price. And as a result, that's more steady for our borrowers. And that's what we're looking for, is steady. We want to make sure that we can get repaid back. And whether it's a good market, whether it's a bad market, we still have the opportunity to get paid back. And in certain areas, especially, the coastal areas tend to be really difficult, where those really large downturns can wipe out anything that a borrower is going to make on a project, and it starts putting the lender at risk. The last one, number 6, and I think this is, how we began. It's certainly our secret sauce. Any bank, any lender can look at a credit score. They can look at an asset value. They can look at track record. There's usually never a checkbox to, did you serve in the military? Why do we like that checkbox? It is a proxy for so many other things that has to do with real estate. If you think about real estate and just at a wide level, like, what is it? It's getting a project from point A to point B. There's always going to be hiccups, right? There's going to be hiccups with getting permits, zoning, contractors, tenants. All of these are potential roadblocks. But if we know that you have been an officer in, not only the Army, the Air Force, Navy, et cetera, but you've served as a military officer, you likely have project manager experience. You likely served in a position of trust. So you're somebody that's going to, follow through with what you say you're going to do. You have a certain amount of grit, determination. That's what it takes to succeed in real estate, is you got to be able to get the ball across the finish line. And so that, to me, is a really unique proxy. We're probably one of the few, if only, lenders that look at that. But I think, and our track record, I think, speaks for itself. This is a way for us to do that. Again, we talk about community affiliated. When I have a military borrower that suggests that he or she has a friend that is also in the flipping business who's civilian, we believe that person has a high degree of trustworthiness when it comes to that as well. And that's a great source of referral for us to do that. So, eligibility criteria. What are some red flags? What are things that are going to completely knock out a file? And what are some things that might make it a little thin, so we need to compensate? So red flags: bankruptcy. If I look at their credit score and there's something on there that's not paid, that's probably meaning that they have a high chance of not repaying. Again, anything below a 675 credit score is going to be a problem. No or limited experience in real estate or project management. Again, we're really trying to hone in on people that have done this before. We really don't want to lend to people that have never done a project before. The few exception would be if they have a military background and they've owned a personal residence, then generally that's somebody we feel like if they have a strong plan in place, we might be able to make an exception. How do we make that exception? We do that with, making sure they have a higher down payment, making sure they have more cash on hand, making sure they have a robust personal financial statement that shows that they have cash to be able to make up the difference if something goes well. Things that knock out loan files. If they don't have income coming to the door, it's going to be hard for them to repay us, right? That's a very simple thing to think about. It's not uncommon for lenders to lend without that, especially if you're a real estate agent, things are slow, you don't have that steady income. That can be normal person that is borrowing money. We try to look for other sources of income so that we know that we can always get paid back no matter what the economy is. Talked about having project manager experience before. That's really something we need to have in order to make a file go forward. We're certainly not going to lend to a credit score below 600, and we really don't lend below 675 anymore. I talked about asset location before. So again, non-judicial foreclosure states, example being California, we're not going to lend in those states. And rural areas, so anything less than 25,000 is kind of where we deem rural. Honestly, anything below 50 is going to at least serve as a potential red flag, but a knockout is going to be anything below 25. Credit history, we don't really see this one a lot, but certainly if there's somebody that doesn't have at least 1 year of credit history, that's going to be a problem. We're going to need at least something else to compensate for that. Again, higher down payment, more cash on hand, et cetera. And the other thing is active duty military. I think the fact that knowing that they have that steady LES W-2 coming in on a regular basis, that gives us a lot of flexibility to be able to give, again, not high dollar loans, but especially for $150,000 rehab loans, having that can be very invaluable. And that LES is really just proof of not only income, but of somebody we believe that's going to have the ability to get the job done. I think this has been covered before, but I think it stands to talk about again. I'll view it from the underwriting standpoint. The big one is the term length. We are typically doing 6 to 9 month loans, in some cases only 3. You're asking, why is that? Why would a borrower want to take on a shorter term? This goes back to my initial point about not being a banker. If you look at our competitors, most of them will say we only offer a 12-month loan product. They don't offer a 6, they don't offer a 3, they don't offer a 15, it's just 12. That's just the, kind of the industry standard. The problem with that is it doesn't really fit every single borrower. Every borrower is unique. And we believe we want to build loan products that are going to fit the borrower's needs because that gives them a reason to use our services, because we're really a service-based organization at the end of the day. So in order to give that service, even before I'm going to quote terms for a borrower, I'm usually going to have a phone call with them. What makes sense for your business operations? We look at view the borrower as a business owner. And so they need to make a business decision that's going to best support their operations, their cash flow, their long-term goals. And so for some of our borrowers, maybe they're going to buy these deals, off market at a steep discount, maybe 60 cents on the dollar, 50 cents on the dollar. Well, if they can turn around and sell that within 30 or 60 days at 70 or 80 cents on the dollar, it makes a lot of sense that they don't probably want to fix it up all the way. Maybe they just want to clear out the junk, put in a new coat of paint, and put it back on the market. And that happens pretty regularly. So for them, if they're going to hold the note for 60 to 90 days, why would they want a 12-month note? Why not get a 3-month note for a little bit of a discount? And that discount, over 1 property, 5 properties, 20 properties really adds up for them. Now, the benefit to us is we're really reducing risk and we're boosting IRR, because instead of doing a 12-month loan, we're getting that payback in 30, 60, 90 days, which means we can recycle that money and continue to boost our IRR over the entire year. But it also reduces our risk. We're not holding these properties for 12, 24, 36 months. They're staying on the books for 12 months or less, and they're off. And so that means that we're getting these properties off our books and we're moving on to the next one. The other benefit of a short-term loan is that if there's going to be a problem with the project, you're going to know sooner rather than later. Because if the duration alone is 3 months or 6 months or 9 months, if at the 5-month mark they ask for an extension, the question is why? It's not always something that's wrong or something that's bad. Maybe the permitting took a long time. Maybe the contractor's been slow, but at least gives us the opportunity to have the conversation with the borrower. It's just another touch point to figure out, are we on track to be able to accomplish the mission that we set out to do? And so again, the shorter term allows us to have that ability. From a, how we make money, there's really three ways that we make money. That's on the origination. So that's, 2 to 4 percentage points of the loan determined based on a number of things: experience, loan to value, term length. All that's going to, factor into what the origination is, to include credit score. The interest rate, we're typically charging right now 11.25 to 11.99%. That's generally where we're at for most of our borrowers. And again, the term length and experience and credit score are all going to impact that number. And then the third way that we make money is our fees. And so those fees are not necessarily from a profit standpoint, but it pays for our team. We're currently sitting at almost 14 people. We're going to be hiring several more in the future. So that's our loan processors, our underwriters, all these people that are part of the Trophy Point team. We've got to be able to pay, their salaries, pay for their software, computers, et cetera. And so those fees help offset all that. And then the last way is if there is an extension for whatever reason beyond the normal time, then we're typically going to charge anywhere from 1/4 to 1/2 point for each month until we get to the final piece. All right. So I've talked a lot, more than I would like to. So I'd like to open up the rest of this for questions. I see one Q&A here. Perfect. So Bradley or Brad, I'm not sure what you go by, but I appreciate the question here. So any concerns that as rates come down and traditional lenders start loaning more, or again, the demand for private lending will decrease? As rates come down, how confident are you that you can still pay out 8 to 12%? Wonderful question. Love it. Okay. Thanks so much. So let's talk about how private lending started. I think, for me, when I first started learning about this in 2008, I'm thinking of private lending as like the movies that you see with The Godfather, right? They give them the offer that you can't refuse, or somebody in a back alley. And in some ways, that was the private lending industry for a long time. Once 2008 hit, which was, again, terrible time, a lot of private lenders started slowly taking market share from the banks. But what has happened since 2008? We had really low interest rates, and yet the banks didn't take back the market share. Why is that? Well, it's because banks, even, whether we have low rates or high rates, so right now we're at a time of high rates, they are going to go down, as Bradley mentioned. But guess what? Banks aren't loaning as much to people that are doing this space. And the other thing that banks can't do is they can't be quick. So even if a bank can offer you 3%, if it takes them 30 to 45 days to close a loan, and you have 15 days to close a loan, you make $0. You're not going to be able to get the job done because ultimately the bank won't fund you. So private lenders, I think, we're a prime example of this. We exist as a service. We're taking that 45-day banking timeline and we're condensing it down to 5 or 10. That's our job. And so that takes a robust team, a robust set of checklists and systems to be able to, operationalize that. But ultimately, we're paid that premium, that those high rates that you mentioned, Bradley, to provide the service of actually getting the loan closed and providing certainty of close to our borrowers. And so as rates come down, we might lend out at, 1/4 point less or a 1/2 point less, but it's not going to really go down, because even at the, bottom of that market, when in terms of rates, we were still lending out, I think, at 10.99% is about, 10.5% was about the lowest we went, and we still had business. And so I do think that as rates come down, some of our competitors who are either Wall Street or institutionally backed, they will bring out products with a lower interest rate than ours. But we have consistently found is the ones that are backed by Wall Street, there's a little education piece. There's several different types of private lenders. There's a balance sheet lender, which is like us, which is somebody who has funds at their disposal to lend out, to and from. The advantage of a balance sheet lender is we can call the shots and we can loan the money on our timeline. The other two types of private lenders who call themselves private lenders are brokers, who essentially are using somebody else's product. They can't guarantee it. They change their terms and their rates all the time, and they're not going to potentially be able to give the speed that we can do as a balance sheet. And the other ones are Wall Street backed ones, which means they have to box them up into a tranche. And so they do loans, they package them up in anywhere from $100 to $500 million tranches, and they sell them off at Wall Street. What's interesting with that business model, and you can look this up online for some of the public financials of our competitors, They lose money most of the time at origination. The way they make money is at the sale, because when they sell that tranche, they make an interest rate spread of anywhere from 3 to 5%, depending on the market and how they originate. So what they have to do in order to get paid is they can't have a single loan out of place. So what we kind of specialize in was what I like to call rectangle or triangle loans. So the Wall Street firm does square loans. They're very good at square loans. They're super competitive rates, and they provide a great service if you have a square loan. But what if your loan needs to close in 7 days? That's probably like a triangle. What if your loan requires an appraisal? Well, ours doesn't necessarily do that for 400,000 under. We use a proprietary product called Richer Values that gives us the same valuation, but it does it in 2 or 3 days, so you don't have to elongate the timeline. So that's like a rectangle loan. So we can do squares, triangles, and rectangles at our business, but the Wall Street business can only do the square ones. And so again, I think those are the competitive advantages we have, that even as interest rates come down, the service we provide will allow our borrowers to do deals that they otherwise cannot do, and they can make money that they would otherwise not make. And as long as we're able to provide that service that allows them to make money, I don't see a situation where we're not able to charge, I think, a premium rate for the premium service. Did that answer your question, Bradley? I know there's a long explanation, but I think there's a lot of, pieces to the private lending puzzle that's a part of. All right. Any other questions out there? Could you expand more on the cash on hand requirement? That's a great question. So what we're looking for is, can the borrower make all of their financial obligations on a monthly basis for the duration of the loan? What I mean by that is, do they have the cash on hand to continually make the monthly interest payments to Trophy Point? And do they have the cash on hand for the down payment and the closing costs associated with the loan? So the example I'll try to give is, let's assume it's a $100,000 loan, and let's go with a easy round number that they're going to have $1,000 a month interest payment, and it's a 6-month loan. So we know that they need to have at least $6,000 in the bank today to be able to make the $1,000 payment month after month in order to pay us that. But we also know that if they have, like, let's say a $10,000 or $15,000 down payment, we need to see a bank account for that as well. So now we're at 6 plus 15. Now we're at 21,000 we're looking for. And the other thing is closing costs. There's always taxes, title, insurance, fees. I'm from the great state of Illinois. I don't live there anymore. Why? Because the taxes are outrageous. So I know that if we're in Illinois and we're closing a loan, your taxes are going to be through the roof, and that's going to be additional closing costs. So I've got to now look for that. So if there's $5,000 of closing costs, now I'm at 15 plus 6, that's 21, plus another 5 in closing costs. Now I'm at 26. So the magic number I'm looking for is, does the bank account have $26,000 in it? That's what we'd be looking for. Now, the other question is, do they have other loans out there? The answer is, if they're with us, we'll look at it. So we'll know that there's other loan requirements out there that they need to make interest payments to. Maybe that's their personal residence. Maybe it's other properties with us. So now we're going to look for additional cash on hand. One of the ways that cash on hand can be offset is through monthly income. So if we know, or we have verified the rent that is coming in on properties their own, we're going to count that with their income in addition to their W-2 job. So those are ways that we're going to look at their total global financial picture to ensure that we're going to get paid back every month, and to ensure that they're going to be successful. Because again, we don't look at this as a process where we want to take back a loan. That's like the worst case scenario. So this is really like, to use a West Point term, cooperate and graduate type model. We want to make sure that we work with the borrowers, and the borrowers are set up in a way that if we're going to partner with them and lend them money, that they're going to pay us back. And so we very much want to ensure that on day one. Hopefully that answers your question. Anybody else out there? Great to hear you, Corey.
Hey, you talk about not wanting to take possession of a property. Have you guys ever had to go through that process? And if so, what's that look like? If not, what makes you guys feel confident you could still get your money out of it if you had to go through that process?
Yeah, great question. So there's a couple ways, obviously, you can take possession of properties. The one that you hear most often is foreclosure. I did speak on the different types of states, and states really do vary on this, right? You got, judicial foreclosure states, non-judicial foreclosure states, but it's even more complicated than that. So some states, especially if there's a tenant involved, can take, months to be able to start the process of evicting that person and then taking back that property. So yes, there's a lot that goes into it. The short answer is we have taken back properties, but not through the foreclosure process yet. Knock on wood, we've had a couple that have come close, but we have come back to the table with those people. Now, the ones that were not in the foreclosure stake, what we have done in those situations is we have talked to the borrower. It goes back to that early and often communication. We had some borrowers that had some financial difficulties because they had several properties. And because we underwrote that borrower knowing that they had multiple other properties, instead of going through the foreclosure process, we went through what's called a deed in lieu. That deed in lieu process allows us to get, possession of any property that's deeded over to us almost nearly instantaneously within, days or weeks. Usually it's really about as fast as you can draw up the paperwork and get it recorded. The benefit of going through the deed in lieu process is I save, fees, I save legal fees, and I save time. Because at this point, if you have a distressed borrower, you need to get possession of that property really quickly and then be able to turn around and either, rent it out or refinance it or sell it. So for us, we assessed the situation with this borrower and said, look, instead of trying to foreclose on them, we're going to offer the ability to take back, not only the properties we lend on, but some additional collateral that we did not lend on. So we actually end up with more properties than we started off with, which is a good problem to have. And so that's how, to your point, Corey, which is how do you assess the risk, is we felt the risk of foreclosure was high in the sense that we were going to go through a long legal battle. It's going to be, dicey on what the valuation is, but by taking back the properties instantaneously and taking back more properties than we started with, that allowed us to ensure that we got back our financials. So does that make sense on that one?
Yeah, and then do you guys just then have a team that turns around and sells it, or?
Yeah, so the disposition can look a lot of different ways. So we'll assess it and say, what's the best use of this property given the market and where it's located. So in the case of that portfolio, some we kept as rentals and some that we ended up selling off. So we looked at kind of the way that we could make the most amount of money because that's best for the fund, right? That ensures the solvency of the fund, ensures that we get the best bang for our buck in that situation. So it can go either way, depending on what makes the most sense profitability wise.
Thank you.
Thank you. Okay. That's my spiel. Trophy Point is who we are. I'm one of the partners there, but more importantly, I hope that I'm somebody that you or anybody else that you think would be a good fit for us, either as an investor or as a borrower, can reach out to. I'm not hard to find. I do that on purpose. I think it's right here. There you go. Right there's my cell phone. There's my email, and I'm always happy to have you reach out to me or anybody on the team at any time. We pride ourselves on our accessibility, approachability, and just quite honestly, we're always open for a conversation. So again, thank you all so much for tuning in. We appreciate all of your time, your trust. We know it's valuable, and we don't make light of it. So again, thanks so much. And if there's anything we can do for you in the future, please don't hesitate to let us know. Y'all have a great day.